what you, thank you, Antoinette, for starting the recording. Then you just enter, like I will do for my language. I'll say. Okay, someone else before me. Okay, so what then they're going to do is this, the result from all of this, we will post on an announcement tomorrow. Just remember this. Okay. We've had 15 responses so far. Wonderful. 33 responses. We'll give another minute. Okay, I'm just going to ask that everyone mute their mics. Thank you. Okay. I'm going to end in 5, 4, 3, 2, 1. 66 responses. Okay, thank you. Seems it's continuing. Okay, but I'm going to continue with the lecture. So as you all know, we're going to discuss depreciation. But as a, before we start with today's topic, I would like to refer to Learning Unit 1 in order to give you some background why we account for depreciation. So the objective of financial statements is to provide information about the financial position, the financial performance, and cash flows of the entity that is useful to a wide range of users in making economic decisions. So these users are either internal users of financial statements, which can be your management or your employees. Both of them may want to analyze the performance of the entity, especially if they are awarded shares in the company or receiving a profit share as part of their remuneration packages. And then management may also use the information to assist with future decision making. Then your external users can be people who are interested to invest in the company or the business. And it can also be creditors or financial institutions, such as banks, who want to ensure that the entity is financially healthy before allowing the entity to purchase on credit or lending funds to the entity. So they would require sufficient security, which would be the net asset value of the company, for in the event that the entity is unable to repay its debt. Then the bank or the supplier can take possession of the entity's assets and sell those assets to recover the debt. So this is just to give you a background as why it is important that the information in the financial statements should be a true reflection of the entity's current financial state or position and performance. In other words, assets should not be presented in the financial statements at a value higher than which it can be realized for. And realized, we mean like selling it, in example. And then for the same reason, liabilities should also not be understated. Otherwise, there might be more creditors in line when the bank or supplier wants to claim assets as security for unpaid debts. So in order to meet the objective of financial statements, the financial statements provide information about the following of the entity. the assets, the liabilities, income and expenses, equity, including contributions by and distributions to owners of the entity, and cash flows. So these top items are presented in the statement of financial position. Cash flows are presented in their own statement, but we are not going to discuss that. What I want to do now is I want to recap whether a debit or a credit will result in an increase or a decrease for these items. Okay, so there I've listed all the items, the assets, liability, income, expenses, and equity. So I'm going to request of you to indicate to me whether you think an asset increases on the debit side by giving me a thumbs up, or whether you think it increases on the credit side by giving me a smiley face. So let's do assets first. Can you give me a thumbs up? I see raised hands. Is there a question? Okay, there's some thumbs up. Sorry, I can't see the names, but I see a number. There's 3 raised hands, 2 raised hands. Can number one first go? Yeah, would you like to ask a question? Sazona? Sazona? Would you like to ask a question? Antoinette, do you know whether they can unmute, or should I unmute them? Or
They can unmute.
Okay, thank you. Then Elias, do you still have a question? Okay, then I'm going to go to Lesego. Do you have a question? Or
Yes, ma'am. Can you hear me?
Yes.
Yes. What I want to ask is, ma'am, is there a way that you can turn off the real-time text? They're right under the slide, and as people type, it becomes kind of distracting.
Ma'am, he has to do it on his end.
Oh, yeah, sorry, I also see something here on my side, but I'm not sure how to, Antoinette, you see that?
Yes, I also saw it. I wondered also about that. I'll see what I can do, but the lady who just said that we can do it or he can do it from his side, can you kindly just say how?
So on the more option, there's an option for language and speech, and then there's an option that says show live captions. You just have to switch that off.
Wonderful. Thank you so much.
Pleasure.
I hope everyone heard that.
Okay, I hope it works for everyone.
Yeah, thank you.
Okay. Okay, so let's go back again. For asset, if you think it increases with a debit, please give me a thumbs up. And if you think it increases with a credit, can you please give me a smiley face? And then if you don't have a question anymore, can you just lower your hand? Elias, I see you still have a raised hand. Do you have a question? Okay, then there's a Sia Kroch. Do you have a question? I think maybe you, if you go to react, that smiley face on the top, and you press on him once, then there you can select either a thumbs up or a smiley face. So I think maybe some people raise their hands.
Sorry, ma'am, that was completely an accident.
Okay, no, it's not a problem. Okay, and then I see another raised hand, B. Tazani. Okay, I'm going to continue. So yes, the asset, I saw a few thumbs up. The asset will increase with a debit. And then a liability, are you going to give me a thumbs up or a smiley face to indicate on which side a liability is going to increase? Anyone? Does no one know on which side a liability increases? Let's just see, is there anything in the comments? Okay. I see a raise hands, credit, right? Yes, that's a credit. Okay, let's go to income. I just see the same hands being raised, so I just want to ask that you just make sure that you are not pressing the raised hand. Okay. I'm going to finish this slide and then I'll go back to raised hands. Okay, so for income, does the income increase with the debit? Okay, there I see. Oh, is there a lot of reactions? I'm just not seeing it. I'm sorry. Okay, let me then just continue. Apologies. Yes. Okay.
Yes, there is a lot of reactions.
I'm so sorry. I don't see anything. Okay, so I'm just going to continue then because of time as well. Okay, so income increases on the credit side, and expenses, I think you already know now, increases on the debit side. And then the equity also increases on the credit side. Okay, so these are some things that we just, can you just mute, please? Can everyone just mute? Just mute yourself, please. Thank you. So like Mrs. Van Eck also said, certain things we just need to study. So if you, you'll have to study on which side each asset increases or not. Okay, so now I'm going to show you a statement of financial position. I'm not sure whether any of you have viewed this before. Perhaps you can just leave me a comment because that I can see if you've seen it before. For the others, can you just quickly look at this statement of financial position? And we'll discuss it just now. Okay. I'm sorry, I'm going to struggle a little bit with interaction, I think, tonight. But please, if you want to ask something, then I think you can just unmute yourself and speak, or raise your hand that I can see. Okay, so let's continue. So for, you can see here on the top, we have our assets. And now we've already said that assets increase with the debit. And then below that, we have equity. And equity increases with the credit. And we have liabilities, and liabilities also increases with the credit. And then your total assets will equal your total liabilities. So now, can you understand where this equation comes from? This is the equation that was Mrs. Dry addressed in her class last week. So if your assets equal your equity and liabilities, you can understand why we say A equals E plus L. So I'm just showing you this just for you to have a broader idea of where everything lies and where it goes. And then maybe you can understand the distinction between what goes into your statement of financial position and what goes into your statement of profit and loss. So then what I just further want to show you is that, okay, first let's quickly have a look at all the items from the previous slide where they are located. So first we have assets here, and then we have our liabilities, as I mentioned, and then total equity, and then now the expenses and the income. In the comments, can anyone tell me where do you think the expenses and the income will end up? Is there anyone that just want to unmute themselves and tell me? Yes, that's correct, the equity. So I split the equity between the capital and the retained earnings. Okay, so your income and your expenses will finally come here. Okay. Okay. But now today we are going to focus on your non-current assets and then also just discuss what current assets are. So let me just, Okay, so non-current assets are expected, or assets which are expected to be used for more than one financial year, whereas current assets are expected to be used within a period of one financial year. So examples of non-current assets is buildings or land. It can be plant, which is used to make inventory, or any other equipment that are, that the business uses to produce income. It can also be long-term investments or intangible assets, but we're just going to focus today on property, plant, and equipment. Okay. And then examples of current assets is inventory, trade receivables, and cash equivalents. Okay. So now we're going to look at what is depreciation. So this paragraph is in your learning unit, exactly just like this on page 25. We're just quickly going to read through this. The first sentence is just also stating what a non-current asset is, that it is something that is used by the entity for more than one financial year. And then through their continuous use, these non-current assets lose value through wear and tear. And the loss of this value is known as depreciation. So depreciation for accounting purposes refer to the allocation of the cost of the asset to the financial periods in which the asset is used. Depreciation is provided in terms of the matching principle, an accounting principle that requires that the expenses incurred during the financial period be recorded in the same financial period as the related revenue, also known as the matching of revenues to expenses principle. Depreciation is calculated for each accounting period using an agreed method of depreciation. Okay, so we are going to have a look today at two depreciation methods. Can you just mute yourself, please? Thank you. Okay, so now let's convert these paragraphs into an example. Okay, assume that the business acquired a new vehicle, which is used. Yeah.
Apologies. The
Yes.
students say that they can't get this live captions off. They can't turn it off. We tried now. I also tried. I wonder if it's not the setting when you are on presentation mode. If you can maybe just check, because it seems that it's very distracting. But there's someone raising a hand. Maybe the person knows what to do. I just want to make you aware.
Yeah. Okay. Can someone? Does anyone know? Don't show chat bubbles. Mute
Hi, ma'am.
notification. Yes.
Yes, sorry to interrupt. I think another option would be for them to open it in a new tab. It doesn't necessarily close it completely, but it won't show on what we're currently working on. So you can open it on a new tab and then it disappears from the bottom.
Okay. Can you explain to us how to open it in a new tab?
So basically at the bottom, there'll be about 3 dots, or the settings button there at the bottom with those captions. And you can literally just say open in new window or new tab and it will move.
Oh, yes. Perfect. Okay. Oh, I see. It's everything that we say. Okay. Oh, that we didn't want to see. Okay. So is everyone fine?
Sorry, can the young lady explain again? I'm still having issues.
Yeah, so yeah, I see I also still have issues. So it seems like okay, let's just quickly see if we can do this. Let me share my screen. Okay, can you see my screen?
Yes,
so it seems
Yes, we can see it. So
ma'am, you basically open in
arrow,
a new
yes.
window. Yes. And then it disappears. So
Do you mean this one?
Yes.
Yes.
Okay, and here?
And now it's
So now,
gone.
so now I just minimize it.
Yes, so it's just moved to a different tab and it won't appear on your screen anymore.
Okay. Okay. And someone give me a thumbs up that I can see if I can see it, please. Okay, so it seems like
Sorry,
oh, there's
ma'am.
a thumbs up. Yeah, yes.
How about you try like switch it off for those that are attending on their phones because we can't switch into a new tab.
You see, I just don't know. I tried. It's not that. Nothing's on here. I'm not sure whether it will work. Yeah.
I don't think you can do it
By
now. I
language
think
and speech, ma'am. Press on language and speech. Yes, and then I don't know if that's
for
gonna help.
language and speech, it's only
Yeah.
applicable to her, not the entire meeting. I don't think you can
Oh,
sort that out now, ma'am. I think the mistake happened when the meeting link was created.
so maybe the person that created.
Yeah, enabled the option for the live
Yeah,
captions.
So
probably.
internet. Thank you,
Yes,
everyone.
I
Do you
checked.
think? Yeah.
Sorry, apologies.
No, no, no.
I did not activate this function. I checked also now. It's not activated, guys. I'm so sorry, but at least the people that's joining with a tablet or a computer, they can switch it off. I'm just quickly trying to see if I show my slides in presentation mode, if there's a way maybe that you can turn it off also.
But we
Okay.
can proceed because it's time
Okay.
consuming.
Yes, it's time. I'm just gonna. Can you see my slides again? Okay.
Yes, yes.
Okay.
Yes,
Thank
I
you.
can see.
Okay, I'm sorry about that, but we are going to continue. Okay, we said assume that the business acquired a new vehicle which is used for to generate revenue. Okay, at initial recognition, which is the date which the asset is recognized in the financial records of the entity, which is usually the purchase date, the vehicle was estimated to have a useful life of 5 years. Okay, so your useful life is the number of years which the entity expects to receive economic benefits from the use of the asset. Okay, so as you use the asset, you generate revenue. Okay, but now the question is, after 4 years, can this vehicle still be accounted for at 150,000 within the business financial statements? Do you think it will be fair to reflect this asset, which is now 4 years older, at 150,000?
No.
No. Yes, that's correct. This will result in your assets of the business to be overvalued, which may mislead the users of the financial statements. And it also, according to the matching principle, as the economic benefits of the vehicle is used to generate revenue, the costs relating to those economic benefits need to be paired with the revenue. In other words, the cost of the portion of the vehicle that are being used to generate the revenue will be expensed in the statement of profit or loss at the time the revenue is generated. Therefore, depreciation is the systematic allocation of the cost of the asset as an expense. Okay, so let's continue with the example that may further clarify what we just discussed. Is it better now for everyone? Can you follow?
Yes.
Okay, thank you. Okay, now I'm going to show you first how we account for depreciation and how it's going to affect all the statements. And then thereafter, we are going to discuss the two methods of calculating the depreciation. Okay, so in this example, we purchase equipment on 1 January 2026 for 100,000 Rand, and our financial year end is 31 December. Okay, so they give us the depreciation for the year. They already gave us the amount. So this depreciation is accounted for from 1 January, which is the date the equipment was purchased, all the way to 31 December 2026. So first, I'm just going to show you how we are going to recognize the cost of the asset. We have a general journal. So we're going to debit, because it's an asset, we're increasing our assets. So we're going to debit vehicles with 100,000. And then we are going to credit our bank, assuming that we paid cash for this asset. Everyone happy with this journal?
Yes, we do.
Someone said I
Yes.
must. Okay. I'm just going to quickly explain this again. Someone asked. I'm just saying in this example, we purchase equipment on 1 January for 100,000. That's why we debit our assets. Actually, should have mentioned the dates here as well. On 1 January, we will debit the asset, increasing our assets vehicles with 100,000. We assume we paid cash for the assets, so we're going to credit the bank. Okay. Now, this example gives us the depreciation for the year. Okay. And now we are going to account for the depreciation. So all I mentioned was that because we purchased the car on, or the, sorry, equipment on 1 January 2026, this 10,000 relates to depreciation for the whole year, okay, from 1 January to 31 December. Later in the class, you will understand why I mentioned this. So then I just quickly want to show you how we account for depreciation. Okay, so you know it's expense. Expenses increase with a debit. So we're going to debit depreciation with 10,000. They gave us that amount. And then instead of crediting the vehicle's accounts, okay, we are going to credit another account, the cumulative depreciation account, which relates specific to vehicles. The reason why this is done is because for, according to IFRS, the International Financial Reporting Standards, you need to disclose this information separately in your financial statements. So that it just makes it easier to group your similar assets together, and then also to separate your cumulative depreciation, which can also include impairments, but we're not discussing that today. We separate them, it just makes it easier for various purposes. Okay, so that's why we credited a cumulative depreciation. So cumulative means it just as it builds up every year. Okay, and so it means it refers to all the depreciation. So, but the depreciation in the profit and loss, which is refers to the will be accounted in the statement of profit or loss. Okay, and this will affect your equity. This will only be for the year. Okay, but this account will reflect all the depreciation from the date of purchase up till the current date. Okay, I see a hand, Zakele. That a question? Okay, Zakele, can you please?
No, I'm sorry. I don't have a question. I had a question, but like, I'm sorry. Never mind. Never mind.
Okay. Are you fine then?
Yeah,
Okay,
I'm
and then
good. I'm good. I'm good.
okay,
Sorry
and
about
that's
that.
great. Sianda, do you have a question?
Evening, ma'am.
Evening, how are you?
Fine, thanks. Can I ask why is depreciation being debited and why is accumulative depreciation being credited? Is
Okay,
depreciation like is it an asset or an expense or?
okay, so this is the expense. Okay, this will be accounted for in your profit and loss, and in the end, affect your equity. Okay, it will decrease your equity. And then the accumulative depreciation is it's listed with your asset, but it decreases your asset. Okay.
Why is it an asset?
This is actually not an asset, but we, like I said, we don't want to decrease our vehicles directly. We use the cumulative depreciation account, which is, you'll see, it's a 200 series account, and then the cumulative depreciation is a sub account. So we actually view them together, but for disclosure purposes, we split them so that we have the information separately available. Okay, but this, as we go on with the class, I think you'll understand a bit better because I'm going to show you now they are color-coded, the amounts. Then you can follow through the trial balance, through the profit and loss account, and again, the statement of financial position. Then maybe you can follow what we are doing. Okay, so this is a sub-account of an asset account. Okay, but its balance is a credit because we want to decrease the value of the vehicle. Does it make sense to everyone else? Or does it make sense to you?
Thank you, ma'am. Thank you. Makes sense.
Okay. Okay. Mbole? Sorry, Mbole. Good evening.
Yes, may I please ask, can you please explain accumulated depreciation? What is it? The meaning of it?
Okay. So when you accumulate, it means that it will be all the depreciation for all the years of the useful life of the asset. Okay. So oh, sorry, I see I wrote vehicles. That should actually have been equipment. Sorry about that. So the accumulative depreciation account is just a sub-account of the asset account. Okay. So, but this account will be credited to decrease the asset. Okay. Does it make more sense to you? I think let's continue with this, and then if it's still not clear after I've finished this example, then I'll come back to that. Is that fine?
Ma'am, I think she was looking for the actual like definition of accumulative depression, not necessarily whether credit or debit, but like the actual definition to better understand what you're talking about.
Okay. Yeah, so that's what I actually already also discussed, is that it's all the depreciation that was accounted for the asset up to date. Okay, so the first year it will be 10,000, then the second year it will be 20,000, and the third year it will 30,000. So this is a balance account. So it will all the depreciation will be accounted for every year. It will be reflected here. Okay, so let me just say, so this is in the statement of financial position. Okay, so it's just important to note that this one goes to your profit and loss, okay, which affects your equity. And this one, like I said, is grouped with your asset account, and it decreases your asset account, and it is reflected in the statement of financial position. Okay. I see there's another hand. Sipayena. Would you like to ask something?
Yes, ma'am. Can you hear me?
Yes, I can hear you.
Yes, ma'am. Okay, just for my own understanding and appreciation of accounting, is it safe to say that accounting has aspects that one doesn't have to look into them in a logical sense, but just know that accumulated depreciation is an asset? The reason I'm asking that is because depreciation is considered an expense, and then at some point when it's accumulated, it's now an asset. So that is why.
Well, but that's
Yeah,
why you know.
no.
Yeah.
Let me finish. I'm saying it says depreciation is an expense, ne? By definition, and then accumulated depreciation is now an asset. Am I correct? So an accumulated
This is not
expense.
the same. This is not the same entry. Okay. This is the contra entry. Okay, so if I continue now, you will see where they both lie. Can I continue and then see if that clarifies your question?
Continue, it's fine.
Okay, yeah, but it's like you said, I could just have said equipment here to decrease my equipment. I just tried to explain that we separate these accounts, that we the cost is always just kept separate from the cumulative depreciation. So you are correct. I could just as well have credited my assets account. But let's just quickly have a look. Just follow the colors. So the depreciation is in yellow, which is the profit and loss, and then which will affect your equity. And then the statement of financial position, cumulative depreciation is indicated in blue. So here we have a trial balance. I know some of this may be new to everyone, but like I said, it's just to explain. And sorry again, this is now equipment, not a vehicle. In my trial balance, I also grouped my assets at the top. I did my equity here, and then my liabilities, just below my equity. And then here I have my other items that will also reflect in my statement of profit or loss. So here you can see it's a depreciation. That was this one, that one. Okay, so that is there now. And then my blue block is here. Okay, never mind that for now. But then there is the cumulative depreciation. So the net of this will be 90. Okay, so say for instance, I said depreciation 10 and my asset here also 10, then it would have been 100 minus 10. Because my asset, when I initially recognize it, I said I debited my asset with 100. So in the next journal, if I, instead of accumulative depreciation, said asset, this equipment, then I would have credited it with 10. So in the end, it would have been that account only. Okay, but now, like I said, we split the two accounts. Okay, does this make it a little bit clearer? Or must I explain again? Okay, yeah, now it was your question. Does this explain it a bit clearer? Thank you for the thumbs up.
Ma'am,
Is that fine?
ma'am, please explain again.
Yes.
It's
Okay.
fine. It's fine in the sense of I
Ma'am, please
understand
explain again.
how you
Yes.
then. I understand the fact that you then made accumulated depreciation an asset. You understand?
Okay.
I'm
Yes.
just coming into the science of accounting in this with another logic that how can an accumulated expense now become an asset?
Because it's a contra entry to the to the expense. So what is
Or
going to happen? Yeah.
The reason is because it's a contra entry.
Yeah, it's not the same thing. Yeah, it will be confusing if you think this suddenly becomes this, but it's not the same thing. Okay. This is in your profit and loss. Okay. And in the end, all of this is going to reflect in your retained earnings. Okay. And then this is a contra entry. So this one is never going to reach here. It's the contra entry. Okay. Matubela, do you have a question?
Ma'am, I think maybe if you can try and elaborate on what a contra entry is, it will clarify what is, because I do understand what you mean, what is happening here. And depreciation is when you're trying to showcase the value of an asset, whether it be an equipment or a vehicle losing value, right? So you'd say, for an example, is losing value by 10,000 on a yearly basis. So then the principle of contra accounts then propels you to then have an account that is called accumulated depreciation. that shows you the value of the actual asset. So the actual asset, whether it be a vehicle, equipment, or whatnot, then needs to appear as a contra account. But if maybe you can explain what the contra account, it will then make sense as to why, because then depreciation does not become an asset when by any means it doesn't become an so if maybe you can try and explain what a contra account is, because it will happen even if it's not with a vehicle. It will happen again when you record depreciation. You need to know that there's a contra account that you need to record that talks to that particular asset. So maybe if you can elaborate for everyone, because I'm unable to explain it, but I think you can at least assist in that aspect.
Okay, thank you. So for every debit, there's a credit. Okay, that's why we always say if we debit vehicle, we need to find where's the credit. Okay, so when we debited this, we credited our bank. Okay, so when we like the first journal which I showed you, so that's why your trial balance is balancing. And also why A equals E plus L, because for every debit there's a credit. So if your initial transaction is a credit, you say, but what is my contra entry? What is my debit entry? Okay, so for every debit there's a credit. So yeah, the wording is maybe confusing, but I'm showing you that it's lying somewhere totally different. Okay, so this one does not become this one. Okay, it's just where we could have, like I said, credited vehicle directly, but we didn't. And I think it would have been less confusing if we did that. But we like I said, we keep it separate. So there's our debit entry, there's our credit entry. Okay, so these two are contra entries. Is that explaining it to everyone? Yeah, the opposite account. Okay. Latita Kumolu.
Yes, ma'am. I just wanted to ask on accumulated depreciation. Does it affect the book value of an asset on the balance sheet?
Yes, I'm gonna show it now to you. Okay.
Okay, thank you.
Sorry, let me just quickly first address this portion. So this is your profit or loss. Okay, so you get your statement of profit or loss and other comprehensive income. Okay, so this is just a few items which are listed here. You get your revenue, your cost of sales, your gross profit, other income. There we have our depreciation. Okay, in the end, we are going to take that balance and we are going to add it to the retained earnings. Okay, so if I go back, you'll see there's your retained earnings on 43, and I'm going to add all of those items to that balance. Okay. So I know this is new to you, but if you perhaps keep these slides and just try to understand all the other entries that happened, then it might be easier for you to understand when you realize that something is in equity and something's in assets. Something is affecting your profit, and then something is affecting your asset. Okay. So any other questions? Okay, let me just quickly show you again. So there's your A equals E plus L. There's a decrease in the asset. So, and here is the decrease in your profit. So A equals E. Okay, I hear someone can't hear. Can everyone else still hear? Am I still audible? Okay, thank you. Okay, are you happy to continue? Victoria, Sebeku? Okay, no question. Okay. So there are two methods of depreciation. Okay, so now previously I just showed you how we account for it. Okay, now I'm going to show you the two methods of depreciation and how we calculate it. So we have the straight line method and the reducing balance method. The straight line method The depreciation is calculated on the cost of the asset using a predetermined depreciation rate, okay? Where if the useful life of the asset can be estimated with certainty, this can be used to determine the depreciation rate, okay? The useful life of an asset is an estimation of the length of time the asset can be reasonably used to generate income, revenue, and therefore be a benefit to the business. Now, the reducing balance method is calculated on the carrying amount, okay? So that would be your cost less your depreciation, okay? Your cumulative depreciation. That is your carrying amount of the asset, also using a predetermined depreciation rate. The carrying amount is obtained by deducting the accumulated depreciation relating to the asset from the original cost of the asset. So that's your accumulated depreciation, not just depreciation for 1 year, which is reflected in the statement of profit or loss, but the statement of financial position account, which has been accumulated. Then the depreciation rate is applied to the carrying amount to calculate the depreciation. So here I am also going to show you an example. Okay, we first are going to look at the straight line method. It's very straightforward. The example is as follows. The cost of the asset is 100,000 Rand again. Okay, the useful life is 10 years. So now,
please,
yeah, yes.
I'm so sorry. Please go back to the previous slide. I just need to see something. Thank you.
Okay. Slides will be made available afterwards within the week. Okay, so this is our example. Now we're going to say, if we either give you the useful life or the depreciation rate, then you can calculate the depreciation for an asset on the, which is measured on the straight line method. So I'll quickly show you. Sorry. Okay. So this is similar to having an orange as your asset, or it's just an example, okay, in your statement of financial position. And then this orange is divided into 10 equal parts, okay? So we say for each year, this is year 1, 2, 3, 4, 5, 6, where, because it's 10 years, and the orange will be reflecting your 100,000 Rand. Then each year we take one part and we account for it in the statement of profit and loss as an expense, as we just said, the depreciation account. Okay, if we calculate it, it will look like this. So we take our 100,000, we divide it in 10 equal parts, and that will give you your 10,000, which is expense as depreciation. Are you all happy with this?
Yes, ma'am. I do understand this example. To make it easier.
Okay, I'm glad. Okay, so now the previous slide also mentioned that if we have the...
Can I just ask? Sorry to interrupt. So with the straight line method, right? And the first example that we did, would that mean every financial year, do we write the cost of the asset as it was at the time that you bought it, or in the new year with the new depreciation? So let's say, for example, obviously this year it's 100,000 Rand. In the following year, that's not the same value of the vehicle, but it also continues to depreciate. So does that mean we change the value of the asset every year with the financial statement?
No, that will be the next method, or more or less the next method. For this method, remember, sorry, I don't want to go back, but the previous slide indicated that we're going to calculate it based on the cost. So this is just on the cost. So it will always remain the 100,000. So you're going to take the cost, okay, and divide it in equal That's why it's straight line method. You're just going to divide in equal parts, and then every year going forward, you're going to take a part and you're going to put it into expense it. Okay. So, okay, pleasure. So now, because we have the useful life, we can calculate the depreciation rate, and we're going to express the depreciation as a percentage to the cost. But I believe Antoinette can maybe, or Mrs. Van Eck can just correct me if I'm wrong, but I believe the depreciation rate or the useful life will just be given. It will not be expected of students to calculate the depreciation rates. I believe it will be given. Am I correct, Mrs. Van Eck?
Hi, Anine. Yes, we will give it to the students.
Okay. Okay, thank you. I see there's a hand.
Yes, ma'am.
Yes.
Yes. Can I please ask what happened if let's say on number 6, for example, the piece of the orange are smashed? What happened? What do you call it?
Then
You're
the
still
asset,
gonna pay for it, number 6.
Number 6. Sorry, just say again, if your asset is impaired.
Yes.
Yeah, well, that's not part of the syllabus, but then you will have to write down the value of the assets. Okay,
Okay.
yeah. So no, that's a very good question, actually. Yeah. So yeah, because we always in the end do we want to reflect the value as close as possible of the asset in the financial statement. So we are not going to continue to depreciate 10,000 Rand if the asset impaired in value, like it was crashed or something like that. Then we will use the new value. Okay, but thank you for that question.
Thank you.
Okay, and then Palesa. Second
Question
hand.
is if we choose to use the straight line method, but the vehicle's market value drops much faster in the first year than in the 10th year, is our balance sheet still accurate?
Okay, but you guys don't seem to me. Yeah, it seems like you are doing the CA route. we are just going to teach you this. Okay, so it's very good questions, but it's not applicable to your syllabus. You have different methods which you account for assets. You have a revaluation, a fair value. So they are those methods are there. Okay, so the cost method usually applies this. Okay, and then you can also revalue an asset at the end of the year, or you can account for it at fair value, which is usually property, where you also adjust the value of the asset. But we just want to teach you the principles of depreciation, and then just make you aware that that the value should be a true reflection of the value of the asset. Okay, but it's very good questions, but it's not applicable to you. Okay, is that fine? It's a lot of different things to study to account that correctly. So just another way to just express this, you have 10 out of 10 pieces. We want to know what is one piece. If you say 1 divided by 10, then you get 0.1. And if you multiply that by 100, you get 10%. But that's just to explain. But you don't have to do these conversions. So now we've calculated that. Let's just quickly apply the depreciation rate of 10%. We say 100,000 times 10, which you can enter into your calculator as 10 divided by 100. And then you see it also gives you 10,000. Okay. So what if okay, you can also, just like there, just also enter 0.1. But now let me give you a question quickly. If the depreciation rate is 5% per annum, and I ask you to calculate the depreciation, it's a straight line method. I'm going to get my poll quickly. Just want to launch the correct one. So then you can select the correct answer. Cost of the asset is 100,000. The depreciation rate is 5%. You can select what will be the depreciation for the year. I see a lot for 5,000. Yes, that's correct. Okay, so let me just bring up the calculation. So similar to that, we're going to say it's 100,000 times 5%, okay, which gives you 5,000. But the majority got it right, so well done. So are there any questions on the straight line method before I move on to the reducing balance method? Okay, then I'm going to move on to the, okay, there's one, Loazi.
Just to get an understanding on this topic of the depreciation. So the 5,000 rand is the money that is expected to be reduced every year.
Yes.
Oh, for the whole 10 years.
Yes, like we said, if nothing else happens to the asset and the asset just matures gradually, then for the whole year, every year you will account for the same equal size portion as an expense.
Thank you very much, ma'am.
Okay. Okay, let's have a look at the other one, then you can see the difference. The reducing balance method, we have the same information. Okay, so the depreciation rate is 10%. Okay, so in the first year, okay, we only have the cost of the asset. There was no previous or prior depreciation written off, so there's no carrying amount to calculate. So as we said, the carrying amount will be the cost of the asset less the accumulative depreciation. So, but now it's the beginning of, we just purchased the asset. So the first year depreciation will be equal to the straight line method. Then after this, okay, we have our orange again in the statement of financial position, it's our asset. And now the first portion is written off to the statement of profit and loss, which will in the end affect your equity. So it's that portion, okay. But in the second year, we say, no, this portion can't play again, okay. I already took in this whole exercise, we are going to remove that portion. So we say our 100% is going to be this portion. Okay, we are going to exclude that portion. And then we are going to, from whatever remained, we are going to divide that also in 10 pieces. Okay, and the second year, we are going to expense this portion, but you can see it's a bit smaller. Okay, so let's just quickly have a look at how it will look if we do the calculation. So the first year we have the cost, we calculate it at 10%, we deduct it, and then we left with only this blue portion, the 90%. Okay, then we take the 90% and we divide it again in 10 pieces. Okay, so we take a tenth of that, we deduct it, and then we have a new carrying amount. But you see, we work now with the carrying amount the whole time. So we take a new carrying amount in the third year and we multiply it 10, and then we get our depreciation for the third year. And so we continue. So that is the reducing balance method. Okay, any questions? Let me just quickly compare the two for you. This is also in your learning units. So this one is a uniform expense charge from month to month, irrespective of the usage of the asset. So say, for instance, you are on holiday and you do not use the asset, or you do not generate income in that month, you still depreciate it. Okay, so that's why they say it doesn't equally match, always equally match with revenue. And it possibly also ignores the decline in the efficiency of the asset over time. So for instance, you have an asset that's producing a product, and in the beginning it was very effective. But as time goes on, it's not as effective, but we still depreciate on the same rate. So that's why they say it might not be as effective to use. And then the reducing balance, it matches cost with revenue more effectively due to the initial higher depreciation when the asset is more efficient for that purpose, okay? And depreciation is reduced as the asset efficiency declines. But then they just mention you have to start with a high rate, because if you start with a low rate, it's going to take a very long time to write off. But obviously, at initial recognition, you estimate how long you think this asset will be used. Okay, there's 3 hands. Matubula, sorry.
Yes, ma'am. I just wanted to ask that maybe for like an exam question, the trick would be one to know how to calculate using a straight line method or using a reducing balance method. So that would sort of be the trick question.
Yes, so you definitely need to read very well, but that's a thing of accounting. You need to read your dates, everything. You need to read it very well, okay? And to know exactly what's asked, but yeah, they can ask you to do it on a specific method. They probably will ask you to do it on a specific method. So you need to know both very well. And remember, they might not always start at the beginning. They might ask you 2 or 3 years further on to give to calculate the depreciation. Okay, next question. I see it's a Mandy. Mandy Ntumbeni.
Hi, ma'am.
Hi.
Ma'am, I wanted to ask a question regarding the two straight line method and the reducing balance method. So the reducing balance method, can you please go back to the balance slide?
This one?
Yes. Yes,
Okay.
ma'am.
Yes.
So you're saying that on this method, we're going to reduce the percentage using the carrying value amount.
The effective percentage will differ, but you will always apply this percentage. You are just going to decrease your carrying amount.
Oh, okay.
Okay, so don't do anything to the percentage. You see, this remaining portion was also divided in 10 pieces. Okay, so your rate will remain the same. You are just going to reduce the balance which you apply to the rate. Okay.
Okay. All right,
Okay.
I understand.
Okay, thank you. Next one is gift, Simangu. Next question, sorry. I see the hand raised. Gift, Simangu, Dimple. Okay, then I'm going to go to Elizabeth Koza.
Hey, I understand everything. So does this mean that when you calculate the straight line, the formula would be cost minus the residual value divided by useful life?
Sorry, I struggle to hear you. Can you just speak a bit slower? Just ask again.
Okay. So in terms of the method to calculate the straight line formula, would it then be cost minus the residual value divided by the useful life of the item or specific thing?
Yes, we are coming to that. Okay.
Oh,
we will discuss residual value just after this. Okay. Okay. I'm just going to ask again, Gift. Simangu, do you have a question? I see your hand is raised. Okay, we're going to continue. So we did this, and this is in your learning units. Okay, so now Elizabeth just asked what we're now going to discuss now. And that is, we are all happy that we know that the value of the asset will decrease as we use it. But then sometimes we can also, at initial recognition, when the asset was purchased, we determine we are going to use the asset for 5 years. And then at the end, we're going to sell the asset, either as a working asset, your vehicle, or maybe for scrap value as well. Okay, so as we do that estimate, and we can, as we continue, that estimate is also updated. Okay, so for this we call the residual value. Okay. I just want to mention for this, we are only going to apply for this syllabus to the straight line method. Okay, so for the reducing balance methods, we are not going to concern ourselves with the residual value. Okay, so in this instance, at initial recognition, the entity just assumed that they will be able to sell the asset for 15,000. Okay, so they are not going to use this portion of the cost of the asset. They're not going to realize it by using it. Okay, they're going to realize it by selling it. So we do not want to depreciate this portion of this 150. Okay, so what we're going to do is, we are going to deduct that 15 from the 150, and then the sum of that we will depreciate over the remaining useful life. Okay. So after 5 years, which was the useful life or the estimated useful life, a total amount of 135,000 would have been depreciated. Okay, so if we just do a test, we're going to say the cost less the cumulative depreciation is going to give you 15,000 Rand, okay, which is exactly our residual value. So at that time, when we will receive the 15,000, we are going to increase our assets, which is a bank. So bank will be increased with the 15,000, and then we will decrease the value of the car. So we will de-recognize the asset from our financial records because we don't have that asset anymore. Okay. Everyone happy with this? There's a question, Bokamosa.
Hi, ma'am. Can you please repeat the residual value part that you just explained?
Okay, yeah. So, like I said, the car has a cost of 150,000, and we want to depreciate this as the asset is used. But at initial recognition, we already estimated that we will sell the asset at the end of its useful life, which is 5 years, for a scrap metal. So now we're just saying that this value is going to realize when we sell it. Okay, it's not going to realize by using it. So this portion of the 150,000, we are not going to depreciate it because at the end of the useful life, that portion will be realized through selling the asset. So we are just interested to depreciate the value of the asset of the one which we are going to, the portion which we are going to use. Okay, remember we said as we use the asset, we are expensing the cost of the asset to profit and loss. Now we're saying this portion we are not going to use. Okay, we are going to, at the end of the useful life, we are going to sell the asset for 15,000. So we say this asset has a residual value of 15,000. We deduct the 15,000 from the cost of the asset, and only the remaining amounts we will depreciate over 5 years.
Thank you, ma'am.
Okay. Okay, Kitsu Ramonu.
I wanted to find out the residual value. Where does that come from?
What do you mean, where does it come from?
How do we know that the residual value is going to be 15,000?
The question will indicate to you.
Oh,
it's not something you calculate. It's an estimate, but the question will give it to you.
Okay, all right.
Okay. Okay. There's
Or put it in your bag.
Sipeyena Nganose. Okay.
Ma'am?
Yes, I don't know who's speaking now. Oh, there you
It's me,
are. Okay, yes.
Can you go back to the concept where you said 150,000 minus 15,000 divided by 5? Why are you now dividing by 5 instead of saying using the depreciation percentage to then calculate the depreciation over 5 years and then subtract it?
Okay, you first, before you apply your depreciation rate, you first want to have the correct value. Okay. So if I understand you correctly now, and you could have also multiplied this with the depreciation rate, but now you've been given the useful life. So you can, like I said in the, I think 2 slides prior, you can go and calculate the depreciation rate first, or but I mean, it's like doing it twice. You already have the useful life, so you divide it by 5. But I mean, the important thing is to understand is that you don't want to depreciate the whole 150,000 rand, because you expect this to sell, to realize. I don't know if you understand what I mean to realize. We always say you realize something by using it, or you realize it by selling it. Okay, so you either are going to this cost you're going to apply by using the asset to generate income, or you're just going to get the income. Okay, so you know at the end, this asset is going to give you income of 15,000. Okay, you don't have to use the asset to get it. You're just going to sell the asset to get it. But this 135, you are going to use the asset to generate other income. So you just want to determine the value that you need to depreciate.
Yes. That's why I'm asking that in this particular question, in this case, we don't have to do, if your givens are like that, cost, estimated, useful life, you don't have to stress yourself with finding the percentage depreciation, because you then
No.
take the okay, so you then take
Yeah.
everything and divide it by 5 to get your
Yes.
annual depreciation.
Yes. Yeah, I do just
Okay.
like that. So, no, sorry, the other slide was just to explain to you how they interrelate, but we will give you the cost of the useful life, or we will give you the depreciation rate. Okay. Just
Yes, that's
like,
why I'm trying to, yeah, that's why I'm trying
yeah.
to grasp, because the question may come in this manner, or it may come in the other manner, but you want to find the same result.
Yes. Yeah,
All right.
that's
Thanks.
correct. That's correct. Okay, Anna, no, sorry, Pin Gubeni.
You can please let Dimple go first, because her hand was up first, then I'll go after her, please.
Okay. I see the Dimple gift his hand is always up, so I think that's an error.
All right.
So then you too.
My question was with regards to this equation. I think I'm trying to understand in what kind of question will this be? Is it where you need to calculate your depreciation value?
Yes. Yes,
Okay.
this, yeah, you will need, you do this when you calculate the depreciation.
All
Yes,
right.
okay.
Thank you.
Thank you. Anna?
Good evening, ma'am.
Evening.
My question is totally unrelated to what you're teaching right now. Is there a way where we're gonna get the slides?
Yes, I think we will upload it everything within this week still. I will just speak with Mrs. Van Eyck.
Anine, yes, that is
Yes.
correct.
Okay, yeah. So the slides and the recording, we will upload it. Okay.
Thank
Is that
you.
all? Okay, pleasure. Then Emma Tlakula.
Ma'am,
Yes.
can I please ask a question? My English is not good. Please, class, don't judge my English. But I don't know whether I'll explain this right to everyone. I think here it's an example of buying a new car. You see that there are 3 steps here. The residual value, it's where the car is new. Then the second one is starting to lose the value. So I think here, ma'am was calculating the depreciation. The 150,000 is the cost of the actual assets.
Yes.
Then that's 15,000. It's a residual value. of the assets. That's why, ma'am, take that cost and minus that 15,000 because it's a scrap value.
Yes.
It's no longer the same value. That is 150,000. Now it changed because there's 15,000 of the scrap value. That's why she divided it by 5, the number of years. That five belongs to the useful life, which is 5 years. That's why she divided it. When she gets the sum, then she times it by 5 because she wants to know if the amount changed to 15,000, how much it's gonna cost by making a difference from the actual amount of the cost.
Yeah, this is actually just a test. I'm just saying, in the end, after you've depreciate the asset for 5 years with 27,000, then this is the outstanding balance. So after 5 years that we've accounted for depreciation at 27,000 Rand, then this will be your balance on your asset. Okay, so this will be your asset account, this will be your cumulative depreciation account, and then this will be the balance of them together. Then one day when you go and you sell the asset now for scrap, then you're going to credit your cumulative depreciation. You're actually going to remove probably the whole car, or you just credit your cumulative depreciation with the 15,000, and you debit your bank with the 15,000.
Oh, okay. Thank you.
Okay, pleasure. Okay, so there's a lot of hands. Anna again. Malobela. Anna, do you want to ask something? Okay. Like the hands change. Okay, I'm just going to say them as I see them. Okay, Matwanye. There's but you know what? We're going to do another question with a residual value. So I think just for time, let's just continue. There's quite a few questions still left. Okay, so there's 2 more principles that we are going to look at. The one is at the beginning now, and then the next one is at the end of the last slide. Okay, so if
Ma'am, sorry.
Yes.
Sorry, just quickly. Will the next slides cover the depreciation method using the reducing balance, or there won't be any question that would require us to calculate the depreciation value using the reducing balance method?
Yeah, we're going to do something of everything. We
All
just
right,
did
thank
now.
you.
We're going to do in a question now. Okay.
Okay.
Okay, so now what we just quickly want to discuss is that previously with all the examples, we accounted depreciation for the whole year. Okay, so we are again here with equipment. It looks very similar to the other example. We purchased the equipment on 1 January 2026 for 120,000, and the financial year end is 31 December. Okay, so they tell us that the depreciation for the year is 12,000. So for the whole year, it's 12,000. So now we can determine that for the depreciation per month, okay, will be 1,000. Just a thumbs up if you're happy with that. Oh no, now all the hands are up. Okay, great. I'm just quickly going to discuss this, okay? So now we ask ourselves, what if the purchase date was 1 July 2026? Okay. Do you think we can still depreciate it from 1 January all the way to the financial year end? We can't do that.
No.
That's right. So we can only depreciate it from the date that we purchase it. That's the date that we recognize it in the financial records. So we will depreciate from that date up until the end of the financial year. So let's quickly see how many months is that. I usually just use my fingers to make sure that I know that this is 1 July. If this was 31 July, I didn't count July. Okay, so 1 July, we start July, August, September, October, November, December, but we also know that that is the middle of the year, so that is 6 months. Okay, so you agree with that? So now, Okay, thank you. So now we are going to determine the depreciation for this asset, which is only for 6 months. Okay. It's very easy figures. So we're going to, as we said, we can either just use the monthly rate and multiply it by the number of months. Okay. Or we can just say 12,000, which is the annual depreciation, and we divide it times 6 over 12, which is 6 months of the 12 months. Okay, so let me see if you understand what I just explained. Let's say our purchase date is 1 October, and we still have all the information exactly the same. So I'm going to give you a poll, then you quickly tell me which you think is the depreciation for 3 months. Actually, very easy numbers. You can just quickly, you can almost see it. Wonderful. Well, that's perfect. Okay, yeah, so that you can see it is 3 months. So it is either this method or this method. Okay, so I think you understand this. Any questions before we go on to the exercises? Okay, let me quickly take those two. First is S. Malobola. Do you have a question? Your hand is raised, number 1. Okay, no hand. Now it's Mboli.
Okay, ma'am, may I please ask, why
Yeah.
did you calculate from the 1st of July?
Yes, okay, so firstly I said it was, sorry? Did you want to say something?
I wanted to ask, why did you calculate from the July 2026 instead of
Yeah,
what?
sorry, perhaps I wasn't clear. Yeah, the information give 1 January, but I said, what if the purchase date was actually 1 July? Okay, so now we say the purchase date is not 1 January anymore. It's now 1 July. So if the purchase date was 1 July, we are for the current financial year. We only have 6 months left. So we will calculate out depreciation, okay, but we will apportion it for just a number of months, which the asset is being depreciated for the current year. The following year, we will depreciate for the full year, okay, but for this year, we will just depreciate it for this portion. Does that answer your question? Thank you. Okay, Lesego. Lesego, I
Yes,
see your
ma'am.
hand is right. Oh,
Yes,
yes.
yeah, I'm here. I just want to know, looking at the slide that we're on right now, would we ever
Yes.
be expected to calculate more or less the same thing, but with a diminishing cost method, so to speak? Like in terms of, let's say maybe like from July the 1st, have your purchase
Yes,
date made
I
year would
think I
be
think they can. Antoinette, will you answer that as well?
Yes, no problem.
Okay.
Yes, you can get that. So, like Miss A said, you must just remember to apportion it. So you don't take the full year, you take it from the date that we ask you from.
Okay, thank you. Thank you, Anthony. Okay, then the last hand I see is you, Sor.
Am I audible, ma'am?
Yes, you're audible.
I'd like to ask, since ma'am is making an example of 1 July, so what if we start at maybe 15 July? Do I count July or do I start from the next month?
Yeah, well, that makes it a bit complicated. We usually say that it's very close to the 1st or very close to the 31st. We will round it, but I think our questions will be very clear because then you have to take 5.5 months. Okay, so then we will actually just test your mathematical skills. But I I think I don't. If it happens, I think it will only be in the middle of the month. I don't think we'll complicate it and make it the 6th of the month or something like that. I think we will keep it simpler. We just actually want to know that you know that you need to apportion it for that period.
Oh, okay. Thank you, ma'am.
Okay. Okay, then let's continue to our first question. So here we purchased a TLB, tractor loader backhoe equipment. We purchased it on the 1st of January 2025, and we purchased it from TLB Pty Limited for an amount of 80,000. Okay, so the information of the question is that the financial year end is 31 December. We are using the straight line method, and our useful life is 5 years. And now I ask you to calculate the depreciation for 31 December 2026. So this is the depreciation for the second year. Okay, just the depreciation, not the cumulative depreciation. Just the depreciation for the year, the financial year ended 2026. Okay, so I'm going to just quickly give you the poll. Just a moment. It's launching. I think it's now visible. Yeah. It's straight line methods, 80,000. Useful life is 5 years. And you need to calculate the depreciation that will be accounted for in the second year. Okay, that looks very good. Yes, your majority is correct. So just put that off. So because it's a straight line method, because we purchased the asset from at the beginning of the year, it is it's going to be the same every year. Okay, there's no apportionment. So from 1 January 2025 up until December 2025, it will be 16,000, and the following year the same, and the following year. So this is a very straightforward question. So if we say what will the cumulative depreciation be, then for the straight line method, and as I said, because we start on the first, it's a full year depreciation, we're just going to multiply it by 2. Okay, so that is the cumulative depreciation at the end of December 2026. So now we are including a residual value. So I want you to calculate again the depreciation at the end of December 2026 with all this other information still the same. You can select the ball. Only 5 responses. Okay. I'll give you some more time. Looks very well. Okay. Thank you for all the responses. Yes, the majority is correct again. It's 14,000. So what we'll do is we will subtract our residual value and divide it by 5. It will give you 14,000. Okay. Okay. Okay, and then just lastly again, if I ask you what was the cumulative depreciation, it will just be the same. We will just multiply that by 2. Okay, I have 2 hands. Sipeyena.
Hello.
Hello.
Yes, ma'am. Can you hear me?
Yes, I can hear you.
Okay. Just on the spanner in the works here, when you
Yes.
I was under the impression that one considers the residual value after 5 years. Maybe the question would say, what is the depreciation at year 2030?
Yeah, I think then your concept of residual value might not be correct. I think you'll have to have a look at that slide again, but you first subtract your residual value, okay? And then that balance you are going to depreciate over 5 years. Because we don't want to depreciate the 10,000. We just want to depreciate the 70,000. And then after we've depreciated all of that 70,000, we are going to sell the asset for 10 years. 10 years, for 10,000 Rand.
What you've done for this. I understand what you've done for this exercise. However, does one run the risk of miscalculating if they consider the actual meaning of a residual value? Residual value for me, okay, in my understanding, is that it's the value of that asset after its useful life, at the end of its useful life. Am I correct or wrong?
Yes, that's correct. That's after you've used the asset, then there's still a value attached to the asset, and that's a residual value. Yeah.
Yes. Now, why would you consider a residual value in between an asset's useful life?
Well, the thing is because you don't want to depreciate the residual value. You just want to depreciate the amount net of the residual value. So I'm not sure what you want to do. What do you want to do with the residual value?
Trying to not confuse myself when the question comes up, because the very same thing happened now, is that I did not consider the residual value in this question because I would consider a residual value at the end of the useful life. And you asked for calculate the depreciation in 2026, and that's in between the useful life, not at the end.
Okay, so I understand what you mean. You wanted to depreciate it over 5 years and then just the last depreciation for that year.
Yes.
Yeah, but then that's
yes.
not equally spread. So in this one, the straight line method, you equally spread
the residual
everything.
value.
Yeah.
Oh, so you equally spread the residual value also.
Well, you equally spread the, if you do it your way, there's going to be 4 years which you will depreciate a higher value than the last year. But you still use that asset for the whole year. So, so you have to deduct it first, okay? So because to spread the depreciation equally over the period. But you're welcome to send us the email again if it's not understandable. Okay. Sorry, we're running a bit late and I don't want to rush and I don't want to not ask a question. But if I'm unable to answer you now, please send us an email, and then I will definitely try to answer you via email. But I've seen that hand, so please keep your hands. It's just if I'm unable to explain it after I've explained it once, okay? So Yanda, you have a question?
Good afternoon, ma'am. So, we listen to John Judge, ne? So I was wondering, where did we get the 2 years from? Since I know nothing about financial accounting, so can you please explain it to me?
So the asset was purchased on 1 January 2025, and I asked for the depreciation on 31 December 2026. So this it's a whole 2025 is 1 year, and then the whole 2026 is another year. Okay.
Okay, ma'am, I got you now.
Okay. 100%. Okay, Queen Zalwa, Lutuli.
Ma'am.
Yes.
Sorry, my question was already answered. Sorry.
Okay. Good. Okay. Then let's just go to another question. Okay, you can just mute yourself, please. So we have the same information. Still, purchase date is 1 January 25. Cost, everything is the same. We have a financial year end now of 28 February. Okay. So it's still the straight line method. It's still 5 years. And now I ask you to calculate the depreciation on 28 February 2025. I'm going to launch it just now. Just want to make sure it's the right one. Yes, I think it's that one. Nice. So it's a straight line method. Remember, you first calculate your depreciation and then you apportion. Just calculate the depreciation for the year and then you apportion. Okay, I think the majority is still correct, and then the top one, the cost was only apportioned, not the depreciation. So let's quickly have a look. So you're still going to calculate your depreciation for the year, and then you're going to apportion it. Okay. Okay. Then let's have a look. Are you ready for the reducing balance method? So Yanda, you have a question? Okay, we have 2 slides left. Okay, we're going to look at the reducing balance method. So financial year ends back to 31 December. And then reducing balance method. Now they give you the depreciation rate for 20%. Okay, then I ask you to calculate the depreciation on 31 December 2026. So only the depreciation on second last poll on 2026. Okay, so for this one, we have to calculate the first year first. in order to get the carrying amount for the second year. So remember, I'm asking for the depreciation for the second year. I see many people give me the depreciation for the first year. Okay, let's have a look. What is the depreciation for the first year? Okay, we apply the rate to the cost. Now the second year, we are going to apply the rate to the carrying amount. Okay, it looks good. I think there's still a lot that's, it's giving me the depreciation for the year 2025, whereas we want the depreciation for the year 2026. So once we've calculated the 16, we need to deduct it from the 80, which is our cost. And then we get a carrying amount, and we will apply the depreciation rate to the carrying amount, and then we will get our depreciation for 2026. I know it's very late, but are you happy? Okay, question. Okay, sending Chantla. Okay, there's a lot of happy people. Yeah, okay, no questions. Okay. So then I also just mentioned, so the cumulative depreciation will then be both of them. Okay, but you can have a look at this slide again when you go through the slides again. So now the last one is, it's just the last slide, and I have to teach you just one more thing, and I need to address VAT. So VAT is, in this question, we have our purchase date on 1 January, the financial year into 31 December. Everything's the same, the useful life, also the straight line method. But now we tell you that both PTY Limited and TaylorMade is registered VAT vendors. So I know that you all know that you pay VAT, but what we just want to explain to you here is that this is the seller and this is the purchaser. Okay, so if both of them are registered for VAT, then the person who purchased the asset can claim the VAT back from SARS. Okay, so the person who sells the asset will pay the VAT to SARS, okay, as an output VAT, and then the person who purchased the asset can claim it from SARS. Okay, so now the question is, okay, I'm just telling you that VAT stands for value-added taxation. Currently, the rate is 15%, and in the next class, I believe you will, Prof. Annelien will discuss this in detail. So we now need to now just determine what the cost for the person is who bought the asset. Just see, I don't think I have a poll for this, sorry. No. Okay, so we just want to, if we exclude the VAT, because we are going to receive it back from SARS, then our cost is going to be 80,000. So we will, this is how it's going to look. You're going to debit your asset with 80,000, credit your bank because you're still going to pay the 92,000. Okay, but then you park the 12,000 in your VAT control account, because at the end of the VAT period, and the VAT period is usually 2 months, which you gather all your VAT, your inputs and your outputs, and then in the end you either pay VAT over to SARS or SARS pays VAT back to you. Okay, so you put everything in a VAT control account, and then once it's your VAT cycle month, then SARS will pay back the 12,000, and you will credit your VAT control account with 12,000. So you see that 12,000 does not, it cancels out. So we can't make that also part of our asset. And that's actually what's very nice about accounting, because it's balancing the whole time. And if you are going to claim this VAT from SARS, you will suddenly get this entry here. And if you know, and you didn't account for it here, then that 12,000 is going to sit here. And then once you enter or process that bank entry for the 12,000 that you received, you're going to wonder what you need to credit. Okay, then you will, in any case, take it out from there. So this is just to say that if you can claim the VAT input, does not form part of your asset cost. Okay, but like I said, in your next lesson or class, you will learn more about VAT. Okay, so that is the end of the class. I just have one poll left. Just want to know where your confidence level is after this class, whether you think you will be able to answer a depreciation question. Any depreciation. Oh, that looks good. Yes, the straight line method is very straightforward. Oh, it's a 50-50. Seems. Okay. Well, it's very good that you're so honest. Yeah, so as Mrs. Van Eck said, we will upload the slides and the recording if you want to look at that again. And then there's your learning units and everything that's uploaded on my UNISA. So, and then you're also welcome to email and ask questions. And I think, yeah, to contact us if there's anything you still need. I just see there's one last hand. The Sege. Do you want to ask something?
Yes, ma'am, most definitely. I just want to ask in relation to the last one on VAT. Are we always going to work under the assumption that we're a VAT registered vendor? Because that's the only time we can claim VAT back, right?
Yes. Yeah, the question will have to tell you that both is VAT vendors. And I'm not sure to what extent, yet the VAT lesson is going to be about, but there's also certain items on which you can claim VAT and others not. And I think you will also be expected to know what those items are. But if you use the asset to generate taxable supplies, which means is that you will generate income on which you are going to charge VAT on, then you can claim the VAT. Okay, unless it's something like a 4x4 bakkie or a passenger car or something like that. There's certain exemptions that you can't claim VAT on, but that you will learn in detail in the next lesson. But yes, that information we need to give you. And I think we will also tell you the opposite. Or if we don't necessarily give it to you, you can't just assume that. Okay, but I believe that information will be made clear. Okay.
All right, thank you.
Okay, thank you. Okay, but then that's the end of the class. Thank you very much for staying up so late and listening to 2 classes tonight. I hope you all have evening. Oh, and then I think there's a student evaluation form that you can just please fill in, and if you haven't fill it in for the class as well, can you also just fill that in? Yes, Letobo. I see the hand, Letobo. Lots of hands. Okay, is that not hands? Sehu, your hands up again.